Assalamualaikum warahmatullahi wabarakatuh. Let me introduce myself. My name is Amanda Seta Prabowo from Management 23D. My NPM is 23411180. In here, I will explain about ratio analysis in finance. Let's begin. Introduction. Ratio analysis is a critical tool used in financial analysis to evaluate the performance and financial health of a company. It involves the comparison of various figures from the financial statement, balance sheet, income statement, and cash flow statement to understand a company efficiency, profitability, and liquidity. Financial ratios provide insight that raw number might not reveal, making them essential from inventory managers and other stakeholders in making informed decisions. The primary purpose of ratio analysis is to assess the strength and weakness of a company by comparing financial metrics to industry standard or historical performance. By using ratio analysis, a company can track its progress, assess risk, and strategies for the future. Types of financial. Number one is liquidity ratios. Liquidity ratios is measure a company's ability to meet its short-term obligation using its current asset. These ratios are crucial for creditors and investors. I'm sorry about that. As they help assess the risk of a company defaulting on its payment. Alright, in liquidity ratio, we have like a current ratio, like a quick ratio. Current ratio is this ratio indicates a company's ability to pay off its short-term liabilities with its short-term asset. A higher ratio suggests better liquidity, though an excessively high ratio might indicate inefficient use of assets. And quick ratio or acid test is the quick ratio is a more stringent test of liquidity, excluding inventory from current asset, as inventory might not be quickly convertible to cash. Number two, we have a profitability ratio. Profitability ratio measure a company ability to generate profit relative to revenue, asset, or equity. These ratios are key indicator of a company's financial success and operational efficiency. And in this part, we have a gross profit margin. This ratio measures how much profit a company makes after deduction the cost of goods sold. A higher margin indicates efficient product and strong pricing power. And net profit margin show the percentage of revenue that remains as profit after all expenses are deducted. It's a key indicator of overall profitability. Return on asset. This is how effectively a company uses its asset to generate profit. A higher ROA means that the company is using its assets more efficiently. And return on equity or ROE, like that. Measure the return generated on shareholder equity, showing how well the company is using the shareholder fund to generate profit. Solvency or leverage. These assets a company's ability to meet its long-term obligation. They indicate the level of financial leverage a company uses and its capability to service this debt. Debt to equity ratio. This ratio compares the company total debt to its equity. A high ratio indicates that a company is financing a large portion of its operation through debt, which could increase financial risk. Times interest earned. Company ability to cover its interest payment with its operating income. A higher ratio indicates a strongest ability to meet interest obligation. Number 4 is efficiency or activity patient. Efficiency ratio, also known as activity ratio, measure how well a company utilizes its asset to generate revenue. These ratios are crucial for evaluating operational efficiency and asset management. Inventory turnover ratio. This ratio shows how quickly a company sells and replaces its inventory. A higher turnover indicates better inventory management. Receivables turnover ratio. Measure how efficiently a company collects its account receivable. A higher turnover indicates that the company collects its receivables quickly, which is a positive indicator of cash flow. Number 5, we have a market valuation practice. Market valuation ratios are used to assess the market value of a company's share relative to its financial performance. These ratios are particularly important for investors. And we have a part of this like a price to earning ratio. This is how much investors are willing to pay for each dollar of earnings. A high P or E ratio may indicate that investors expect high future growth, while a low P or E could suggest undervaluation of low growth expectation. Dividend yield. This ratio shows the percentage return investors receive in the form of dividend relative to the market price of the stock. Limitation of ratio analysis. While ratio analysis is a powerful tool for assess a company performance, it has several limitations. It's number 1, like industry differences. Ratio can vary significantly across industries, making it difficult to compare companies from different sectors. Number 2 is historical data. Ratios are based on historical financial data, which may not reflect future performance, especially in volatile market. Number 3 is accounting policies. Companies may use different accounting methods, which can distort ratio companies. Number 4 is short-term focus. May ratio focus on short-term metrics, potentially overlook long-term trend and strategies. Maybe just only that what I can explain and what I can say ini. I say sorry if I say a very difficult word or wrong word in here presentation. Alright, thank you.
If the sun refused to shine,